All right, hello everyone. I just wanted to take some time and go over the beginning of chapter 10. Um, Really great job so far on all of the material that we've been going over. Great work. Let's keep the momentum going. Big thing, chapter 10 is we're looking at liabilities. The portion we're going to talk about is the first half of chapter 10. And a lot of this we've already talked about and we've already seen, but I wanted to refresh. So when we talk about current liabilities, we're looking at debt and we're looking at items that are expected to be paid within 1 year. So we're looking at typically it's a 12-month period. So these are 12 months or less, right? So some examples of current liabilities, these are accounts payable, notes payable, any unearned revenues, wages payable, interest payable. These all fit in the category of current liabilities. Now, when we touch on a note payable is actually a promissory note, a promise to pay. So you're looking at lending when we're talking about this, and this is usually um, meant for short-term financing needs. Reason being, it's a current liability. We're looking at a 12-month or less period. Um, the other thing is that there's interest involved. So that's lending again. And remember, interest is the cost of money. And many times you'll see accounts receivable that are overdue, they're turned into notes payable. Um, Another current liability are sales taxes that are payable. So these are collected, right? At point of sale. These are not taken by a retailer, they're collected, which means it's being passed on, it's being taken for the typically the state. You know, you have city, you can have county taxes, but these are tracked and they're collected and then they're sent to the respective government area. And these are also what we call current liabilities. Then we've got payroll and then payroll taxes. So if you remember that when we talked about the difference between salaries and wages. So salaries, we're looking at a fixed rate. So that could be a fixed monthly payment, or it could be a yearly amount, which is a salary. And wages can be determined by hour, right? Or it doesn't say this here, but also units of production. So the units of production or the rate per hour. Um, and then when you're looking at payroll, you're going to look at the gross earnings and then payroll deductions, and then what you have left over, which is the net pay, which is actually, what you as the wage earner or the worker receive after everything's taken out of your paycheck. So this is what it looks like. So we got the gross pay. So you see that happy face, that's the total amount. But then as we're moving along, we see the payroll deductions, and that net pay, that face isn't as happy, right? Because you've got any type of um, insurance, your 401k, any pension, union dues that's coming out, your FICA, so these are your taxes, your federal income tax, any state or city taxes are coming out. You've got that heart there. If you're contributing to a charity, that'll also be coming out of your gross pay, and whatever's left over, that'll be your net pay. For those who may pay, there's child support. There's even child support there, so that could be taken out as well in your net pay um, as well. So that's all part of the payroll. Now, this is payroll tax expense that's any additional taxes that government agencies they put on employers. So employers also pay taxes for having employees. So the employer is going to pay a share of FICA, which is Social Security taxes, federal and state unemployment taxes. So these items all have to be accounted for as well. Now, these are expenses on the employer's side, which as the employee, you won't see these expenses. Now, another current liability is unearned revenue, and these are revenues that are received before the service is provided or the goods are delivered. Big ones we see, if you think of airline, you know, the airline actually earns that revenue for the ticket when you fly. So when you reach your destination, right? But you pay for the ticket ahead of time before you fly. Another one is a hotel, right? I like this example because you really the hotel doesn't earn it until after you've made your stay, right? But you pay up front for that. Then the other is the magazine publisher with subscription revenue because you're paying for the magazine, but then you got to actually receive the issues or the of the magazine. So this is great unearned revenue. These are also current liabilities. So when we go into long-term liabilities, really we're looking at 12 months plus, right? A year or more, as far as obligations that are going to be paid, right? We're looking at 12 months or greater. Um, and a long-term liability is a bond. So we saw notes payable, but let's look at bonds. Now this is a name for, again, interest-bearing note payable, key point, 12 months or greater. So we're looking at greater than a 1 year period. Uh, the big advantage to raising capital over common stock or equity is that stockholder control, that ownership is not affected. You get a tax savings effect with this because of the interest, and the return on common stockholders' equity may be higher, right? Um, there's also a note in here that besides corporations, you got governments and universities, hospitals. They use bonds as a way of raising capital, right? Capital, so to bring in cash to that organization. So looking at the bond basics, you've got secured bonds, which are backed by some type of what we call collateral, and then you've got unsecured bonds, which are not backed by collateral, which are really backed by credit, right, or the faith of payment or repayment of the bonds. And then we have some bonds that are called convertible bonds, where you can change them from a bond and they can move into stock. So they can go from debt to equity under certain circumstances. And then we've got what are known as callable bonds, where you can actually, they'll bring in those issues of bonds from you, force you to really give them back to the issuer. Very interesting. Now, just to dive into it, the nuts and bolts of a bond, again, we're looking at lending note payable, so it's a promissory note. You've got a promise to pay. You've got a certain amount of money, typically $1,000 increments, um, and you're promising to pay that on a certain date, right? You've got interest, which is the cost of money, because there's capital involved. So we've got cash. So we're lending cash, and the cost for that is the interest. Typically, the interest payments are made semi-annually, so every 6 month period. Um, and the bonds are again, typically you're going to see a bond issue to obtain, you know, uh, a good sum of cash, of capital. Um, and who issues or who helps an organization with this whole process is what's called a investment company. Investment company is who helps out with this whole process. This is what a bond looks like. It breaks down the face par value. You see the interest rate there, the maturity date, and you've got the issuer. So this is great. This is an example of it. You normally won't actually see a bond certificate. Everything's done electronically, but this gives you an idea of what the actual contract or the promissory note, when we look at it, the bond agreement looks like. So um, that's really the gist of the first part of chapter 10. A lot of good stuff, a lot of great stuff. Make sure to get in there, dive in, and really read the material, work on the problems. Let me know if you have any questions, and just keep up the great work.